Welcome to this deep dive. Today, we're jumping right into the latest from TriplePoint Venture Growth BDC, TPVG.
Yeah, ticker TPVG.
Exactly. And if you caught the action after their Q2 2025 earnings release, well, you saw the stock take a pretty serious hit.
A serious hit is right. A punishing 8.3% drop on the day.
That kind of move definitely gets your attention.
It really does. And, management was on the call talking upscale, durability, alignment, the usual positive stuff.
But the market wasn't buying it.
Apparently not. The selling pressure was intense. So our mission today is clear. Figure out what was in those results, what strategic changes they announced, and what it all means for TPVG long term.
Okay, let's kick off with the numbers that seem to trigger that immediate sell-off. The headline miss.
Right. Net investment income, or NII, that's kind of like the EPS for a BDC.
Right, the key profitability metric.
Exactly. It came in at just $28 per share.
28 cents. And consensus was looking for, what, closer to 30?
Yeah, about 0.296 cents. So missing by 5.5%, or about 1.5 cents per share. It doesn't sound like much, but in the BDC world, covering your distribution is everything.
So the NII miss rings alarm bells immediately.
Absolutely. And then you layer on the top line, total investment income. Think of it like revenue.
How did that look?
Also light. Came in at $23.3 million.
Okay. Missing estimates there too.
Yep. Missed by almost $1 million. And maybe more importantly, it was down quite a bit year over year. It was $27.1 million same time last year.
Oof. So NI miss, TI miss.
Yeah,
you can see why the market reacted.
Precisely. That combination, plus a pretty major policy announcement they made right after the results dropped, it led to a huge volume day.
How huge?
Trading volume was like 4.3 times the normal 3-month average. Yeah. Just massive outflow. Clearly, investors were focused on that shrinking income.
Voting with their feet, as they say.
Definitely. But here's the interesting part, maybe the paradox.
Yeah.
If you look beyond those headline income numbers, the activity in the quarter was actually quite strong.
Okay, so they were busy. What were they doing?
Very busy. They funded $78.5 million in new investments during Q2.
$78.5 million. That sounds like a lot.
It is. It's actually the highest level of funding activity they've reported in the last 10 quarters. So 2.5 years.
Wow. Okay, so they're putting money to work, growing the portfolio.
They are. The total debt portfolio grew to over $663 million. And the yield they're getting on those debt investments, the annualized yield, looks pretty good on the surface, 14.5%.
14.5%. That seems strong.
Yeah.
So where's the disconnect with the income miss?
Here's the catch. That 14.5% includes accelerated prepayment income. When companies pay back loans early.
Right. Often happens with an acquisition or a big funding round. Can be lumpy income.
Exactly. Very lumpy and often high margin. If you strip that out and look at the core portfolio, just the regular interest payments, it actually slipped a bit. It was 14.1% in Q1, dropped down to 13.6% in Q2.
Okay, wait. So core yield is ticking down, and the lumpy high margin prepayment income is slowing down compared to last year.
That's the story. That's what really drove the drop in the total investment income year over year. Less prepayment juice.
So even though they're funding a lot, the actual income generated from the whole portfolio is decelerating a bit. That feels structural, maybe, not just a one-off.
It's certainly a headwind. That smaller average debt portfolio size compared to the peak last year, plus much less prepayment income. That was the primary explanation given. When prepayments dry up, BDCs feel it right away in their NII coverage.
Makes sense. Okay, given that income pressure, let's look at the balance sheet. Did the foundation hold up? You mentioned net asset value, NAV.
Yeah, surprisingly, or perhaps reassuringly, the NAV actually ticked up slightly this quarter, ended at $8.65 per share.
NAV up, despite the income miss and lower core yield. How?
Well, the core operations are one thing. The value of the underlying assets is another. We'll get into the specifics, but it points to strength elsewhere in the portfolio. Plus, their leverage is still pretty moderate.
What's the leverage situation?
Net leverage, after you account for cash, is sitting at 1.04x. Their target range is way higher, like 1.3x to 1.4x.
So they have plenty of room to borrow and fund new deals if they want to.
Absolutely. Significant funding capacity remains. That stable NAV and moderate leverage provide a buffer.
Okay, good to know. But now we have to talk about the big strategic move, the one that probably amplified the market reaction.
The dividend cut, yeah. No way around it.
They took the regular quarterly distribution down pretty hard, from $0.30 per share.
Down to 23 cents per share.
23 cents, that's a 23% cut. That's significant.
It's a major reset. Management framed it very carefully, called it a prudent move.
Prudent how? What was the logic?
Two main reasons given. First, to get the payout better aligned with the current level of core earnings and actually start over-earning the distribution right away. Build some cushion.
Okay, aligning payout with reality. What's the second reason?
Proactively accounting for the future. They know they have debt maturing in 2026, and refinancing it is going to cost more. Higher interest expense is coming.
So cut the dividend now to prepare for higher debt costs later.
That seems to be the thinking. Get ahead of it, build coverage.
But still, a 23% cut. I mean, regardless of the strategic rationale, the market often just sees dividend cut and thinks trouble, right?
Almost always. It signals risk. Even if management intends it defensively, they had to know the market would react badly.
So did they do anything else to try and cushion that blow? Signal confidence?
They did. Two pretty big things, actually, aimed directly at shareholder alignment.
Okay, what were they?
First, the advisor, the entity that manages TPVG.
Yeah.
They announced they're waiving all their income incentive fees for the rest of fiscal year 2025.
Whoa, okay. That directly helps NII coverage, right? Less fees paid out means more income stays with the BDC.
Exactly. A direct, tangible boost to the bottom line for shareholders for the next few quarters.
And the second thing?
The sponsor, TriplePoint Capital, or TPC, they launched a discretionary share purchase program in the open market.
A buyback. How much?
Up to $14 million.
$14 million? That's not insignificant. Sends a message that the insiders think the stock's cheap, especially after the drop.
Precisely. It signals belief in the value, and it provides actual potential buying support under the stock price, especially when it's trading below NAV.
Okay, so dividend cut is the bad news, but fee waivers and a buyback are the attempts to soften it and signal long-term confidence. What about growth? Are they still focused on originating?
Very much so. Management spent a lot of time talking about a robust origination pipeline. They're clearly focused on scaling up and also diversifying where they invest.
Diversifying how? Any specific sectors?
Big emphasis on AI. That was mentioned multiple times.
Ah, the AI megatrend. Makes sense.
Yeah, they see it as a huge macro tailwind. These AI companies need enormous capital for compute, for infrastructure. Perfect fit for venture debt, they argued.
Did they name any specific AI investments?
They did. Mentioned adding Marvin, Eightfold, and RudderStack recently, all firmly in that AI ecosystem space.
Interesting. Anywhere else besides AI?
Yeah, they talked about focusing on other, what they call durable sectors, things like verticalized software, aerospace and defense, cybersecurity.
Sounds like they're maybe shifting towards potentially safer, better capitalized company.
That was the implication. Focusing on quality, strong venture backing, maybe less on just pure hypergrowth potential alone.
Which might be needed because didn't credit quality slip a little bit?
It did, yeah, just slightly. But it's worth noting, the weighted average risk rating on their portfolio moved to 2.17.
Up from what?
Up from 2.12 the previous quarter. So a minor deterioration overall.
Was there any specific company driving that?
There was one notable one, yes, a company called Fubana.
Fubana, what happened there?
It's a B2B marketplace, had about an $11 million loan balance. It got downgraded pretty significantly from their Category 2 rating all the way down to Category 4.
Category 4 is usually pretty bad, right?
Yeah.
High risk of loss.
Yeah, indicates significant concern. What happened was, apparently, some investors pulled out of a signed funding deal, a term sheet.
Ouch. That can be fatal for a venture-backed company.
It can force the company into a strategic review. It's a good reminder that even with the broader market stabilizing, individual company risk is still very real, especially for highly leveraged firms.
Okay, so a bit of a credit headwind with Fubana, but you said NAV went up. How did that happen with a downgrade like that?
Ah, the other side of the balance sheet, the equity and warrant portfolio. That's where the good news was.
Okay.
There was a substantial markup in the value of their warrants and equity holdings, about $7.3 million worth.
$7.3 million, and that was enough to offset the Fubana issue and push NAV higher.
Yes, and it was driven almost entirely by one single massive holding.
Which one?
Revolut, the big European fintech.
Ah, Revolut. Okay, they've been in the news.
Exactly. Management specifically cited Revolut's recently announced strong financials, like $4 billion in revenue, $1 billion in net profit.
Impressive numbers.
Very. And there was talk of a subsequent private funding round valuing them at potentially $75 billion. So, TPVG marked up their equity stake significantly based on that.
So that Revolut holding is kind of the hidden gem, propping up the NAV while the debt side faces some income pressure.
It's definitely the latent value story, a huge potential asset on the books.
Okay, speaking of future pressures, let's talk about that refinancing hurdle you mentioned, the debt coming due.
Right, this is a big one looming. They have $200 million worth of fixed-rate notes maturing in March 2026.
$200 million, and the rate on those notes.
Get this, 4.5%. Fixed.
Wow, they're not getting 4.5% on new debt today.
Not even close. The interest rate environment is completely different. So refinancing that $200 million is going to mean significantly higher interest costs.
How are they planning to handle it?
The plan is a mix of issuing new unsecured notes, which will definitely carry a higher coupon, and using capacity on their existing revolving credit lines, which are likely floating rate.
So either way, higher costs are baked in, which explains the prudent dividend cut again.
It really ties back to that. They're building a cushion for that inevitable increase in debt expense come 2026.
Makes sense. What about the near term? What's the outlook for Q3 funding?
They guided to a more modest range for Q3, expecting fundings between $25 million and $50 million.
Okay, a slowdown from the big Q2 number. Why?
They mentioned some potential seasonal slowness, maybe lower utilization rates on existing credit lines. It sounds like the really substantial portfolio growth might be pushed out more towards 2026.
Assuming originations hold up and, maybe crucially, that prepayment activity stays lower.
That seems to be the bet. Slower prepayments mean the portfolio can actually grow steadily.
All right, lots to digest there. Before we wrap up, it's time for my favorite part.
Yes, the "this is not financial advice" segment.
Exactly.
Yeah.
Where we pitch a perhaps slightly outrageous but maybe plausible trade idea to our imaginary investment committee. Reminding you, the listener, this is purely speculative, entertainment only.
Okay, lay it on me. What's the pitch?
Well, the thesis here is pure contrarianism, betting against the panic.
Okay, I like it already. Go on.
The market saw Dividend cut and smashed the sell button, right? Treated it purely as a sign of weakness.
Pretty much ignored the defensive rationale, the fee waivers, the buyback.
Exactly. They ignored the strategic moves designed to stabilize things. So, the pitch is, the market overreacted massively, created an artificial discount.
So the trade is?
We go long TPVG, right here, right now, at this built-in-down price.
Buying into the weakness.
Yeah.
Bold. What's the anchor for this trade?
Two things. First, that $14 million share buyback from the sponsor, that provides a potential floor, actual buying demand right when the stock is below NAV.
Okay, sponsor support is a backstop. What's the second anchor?
The fee waiver, that's real money going straight to the bottom line, boosting NII coverage for the rest of the year. It directly counteracts the income pressure that spooked the market.
So you're saying the combination of the buyback and the fee waiver creates a short-term safety net for the stock price?
That's the idea. It limits the downside, but the upside, that's where it gets interesting.
The catalyst.
You basically own a cheap call option on that massive Revolut stake.
Leveraging the equity upside.
Precisely. The stock is trading based on the troubled income story, not the potential value bomb sitting in that Revolut holding, or even the potential of those AI investments they're making.
So any positive news on Revoluts, a funding round, an IPO filing, even just strong rumors,
could cause a significant repricing of TPVG stock. The capital appreciation could swamp the impact of the lower dividend yield pretty quickly. You're buying management's alignment signals before the market fully prices them in.
Okay, I see the logic. Contrarian, anchored by the buyback and fee waiver, with a lottery ticket on Revolut. Plausible, if definitely requires some nerve.
That's the game. All right, let's try and summarize this deep dive. TPVG definitely had a rough patch in Q2. Missed on income, mostly due to less prepayment activity.
Right, but showed strong funding activity, putting a lot of capital to work, highest in over 2 years.
Then came the big strategic reset. A significant dividend cut, yes, but paired immediately with advisor fee waivers and a sponsor share buyback, trying to stabilize the ship.
All while dealing with a slight credit hiccup like Fubana, but also highlighting the huge unrealized value in Revolut, which kept NAV stable. And they're facing that big refinancing wall in 2026.
So they're trying to get ahead of challenges, lean into AI growth and signal alignment, but the market clearly focused on the immediate income miss and dividend cut.
Which leaves us with a final thought, maybe a provocation for you, the listener. As the whole BDC sector potentially faces moderating yields, is TPVG's aggressive strategy, cutting deep, waiving fees, buying back stock, actually a sign of proactive health? prudent management?
Or is it more of a necessary defense, a reaction forced by maybe some structural issues in the venture debt model itself right now?
What is that huge sell-off, that massive capital flight after one earnings report? Tell us about overall investor confidence in the stability of venture debt income streams today. Something to chew on.
Definitely something to think about. Use this knowledge, mull it over. We'll certainly be watching TPVG closely next quarter. Thanks for diving deep with us.